Hello and welcome to the Small Business Briefing. I'm Brian Kelly, CEO of the Small Business Association of Michigan.
Good afternoon, everyone. Thanks for tuning in today. I'm Sarah Miller, Vice President of Marketing and Strategic Communications. We appreciate you joining us. And we're also excited to welcome one of our new members, River City Dermatology. They're located in Ada. So welcome to Beth Sweeney and her team. We're happy to have you on board. All right, let's get into today's topics. Brian, the European Union Central Bank made the first interest rate cut of kind of this current economic cycle. What, if anything, does that mean for us here in the US?
Yeah, this was a pretty big shift in international monetary policy. And while the major economies around the world and the major currencies around the world that are whose policy is set by central banks, they don't move in concert, but it really does. It is something that what the peers are doing matters quite a bit. When is the right time to start cutting rates? When the European Central Bank, so this would be the bank that was formed with the European Union and the creation of the euro back, I think, in 1998 or 1999. This is the central bank for the majority of Europe. When dealing kind of on the same schedule with the United States, and the Federal Reserve here had raised interest rates up in their case to for the prime lending rate there to 4%. That was the highest that it had been since the beginning of the euro. And this is the first, it marks the first cut. So taking it from 4 to 3.75% was the first cut since 2019. So since the pandemic and this period of inflation that came afterwards, this is the first move downward. It was last week, I think Thursday, and then the day before that, the Canadian Central Bank had lowered their interest rates as well. So it doesn't have any kind of formal or direct impact on what the Federal Reserve does here. But I can tell you that the inflation numbers don't look any better in those countries than they do in the United States. And like the idea of those central banks starting to loosen up the monetary policies that are meant to slow down the economy, that creates a certain level of pressure, I think, that makes it more likely that the U.S. Federal Reserve will start to lower rates this year. So I've always, you might remember if you look back at our original recordings, I've always thought that they would start to reduce interest rates this year because, I mean, in election years tend to go down in election years, and but inflation has been pretty persistent at a level that is lower than before, but still higher than what the monetary policy calls for here. It's really put the Federal Reserve in a sticky situation. But I think two other major countries or two other major currencies and central banks around the world starting to move their rates down, I think does increase the likelihood that yet this summer we might see some loosening of monetary policy here in the United States.
All right, let's talk about CAFE standards. The Biden administration has backed off these standards of the corporate average fuel economy standards. What does this mean?
Yeah, this is you might recall when the Biden administration had come out with new CAFE standards. It's a fuel efficiency standards for vehicles that are sold here in the United States. The proposed rule that they had out before was 57.8 miles per gallon on average. So an automaker's fleet sold in the United States would have to meet that fuel efficiency on average. And so it really was one of the major things that would have pushed the whole system more to electrification. That was backed off somewhat to by 2032. Now the standard of the rule would require 53.5 miles to the gallon, so about 8 to 10% reduction in the fuel economy standard that would be required, and that is it's probably a nod to the concerns that the unions are having with respect to the rush to electrification and the impact that it will have on employment in the United States, and especially here in Michigan. So on the one hand, it's a little surprising to see some of the environmental policy backed off on when there's been kind of full speed ahead, full charging forward. But then when you consider it's an election year, the kind of renewed vigor and strength of the unions, particularly the unions within the president's party, that political parties, keep in mind, they're kind of like coalitions of different groups. And so within the Democratic Party, you have different coalitions that include the unions, environmentalists, more social liberal causes, and they kind of form a coalition, and that's the party. The Republican Party has the same thing. In this case, it's really a sign that the unions and the idea of protecting jobs here at home has moved up in terms of overall importance. I think this is really just, yeah, there's a lot of signs that that's happening, that for a while it seemed like the balance was kind of away from unions. Definitely look like it's tilted more toward them. And I think this is really the yet another sign of that, and probably does have some. It's still a pretty high fuel economy standard, one that I think will be difficult for the industry to reach, and probably will be adjusted downward more before it takes effect. But I think that this type of policy change is the sort of thing that would interest union membership or unions themselves here in a state like Michigan that has such a high proportion of the automotive industry in it.
All right, I know you have a pretty robust Data Monday report for us today, including the latest jobs report and labor force participation. So I'll let you take it from there.
All right. Well, let's take a look here. There are several aspects of this of the data that came out late last week that I'd like to share. First is just the national unemployment rate came in at 4%. So as you can see, there's kind of a little bit of an upward trend here over the course of the last couple of years, but still historically at a pretty low period. Actually, looks pretty close to what you'd have seen in the pre-pandemic times, and also about as actually lower than before the Great Recession. The jobs report came out, and it came out at 272,000 jobs. This is nationwide, and as you can see this month right here, and how it looks compared to these other months over the course of the last year, and then going all the way back to that very robust recovery immediately following the very beginning of the pandemic. And so it looks pretty level when you look at it on such a wide view. But if we zoom in a little bit and look at just the last 13 months, so this May back to last May, you'll see that it's actually on the higher end. It's on the higher end of the range for the last year. And so it really doesn't look like a declining trend. It looks pretty consistent. And there was maybe a little bit of disappointment among the investor market that was still looking for signals that that the Federal Reserve might start to lower interest rates. The jobs report is something to look at pretty closely. But even though this isn't maybe as low as what the markets were looking for, it still looks real. I mean, this range is not really that wide when you compare it to some of the swings that we've seen in the time periods before this. What's maybe a little bit more concerning from an economic development standpoint is where the new job growth is centered. And this is something that if you've been paying attention to our briefings going back several months, you'll see that these top two categories, education and health and government, which are both heavily publicly funded categories. They're, in other words, tax dollars or government payments that contribute the majority of the activity in these categories. That's where the majority of the job growth has been coming. And then while it's been positive, much less of the job growth coming from the private sector categories. And so There has been robust job growth, but it has been centered, certainly this year has been centered in more government funded jobs. Now look, turning over to wage growth. So we saw unemployment, we saw overall jobs growth. Now how about wages? This is a look monthly. So the month over month average hourly earnings in the US was up 0.4%. And as you can see, looking at the last couple of years, pretty average for the last couple of years. And then if you look at it from a year over year standpoint, I would draw your attention to this bottom chart, which is the amount that wages are up over the previous year at the same month, and that's 4.1%. So wage growth annualized 4.1% for this last month and in May over the May of the previous year. And then this is, as you know, I say it every month, that this is actually my favorite chart, which shows income growth compared to inflation. And inflation is always a month behind the income numbers. So we'll get the new CPI numbers here. Actually, I should have looked it up either, I think next week. But 4.1 for income, and then last month and the inflation, the annualized rate at 3.4%. So as you look at it kind of in conjunction, you see a little bit of real income growth here. So annual over the last year, the difference between inflation and income, about 0.5%. And then looking at our next chart here is labor force participation. And this first, if you look at the bottom chart here, as you see, it kind of drops down a little bit, but I think it might be hidden by the image here. But if you look at the top, that's just looking at labor force participation on ages 25 to 54, you'll see that it's actually up. It's up to a level that we haven't seen since before the Great Recession. And so this is the bright spot. We're going to get to a part here that's not so bright in a minute, but labor force participation, 83.6% for the prime working ages, 25 to 54 years old. But on the overall labor force participation, we see that has dropped. So that means that younger workers and older workers have dropped out of the labor force at a rate that made the overall labor force participation drop. It had been pretty consistent. We saw, especially among women, it was increasing over the last few years. Among men, it was pretty level, and so the overall had been kind of creeping upward a bit. But this last month, we saw the labor force participation among men and women overall both drop somewhat, and it came out at 62.5%. And as a picture of what that means for the entire workforce, for the United States, it means it's down about 408,000. And as you look at this bar chart, you see it's down. It's been jumping all over the place. Labor force participation up and down. This is not a huge range of those jumps up and down, but it's very difficult to look at that and get any sort of a trend out of it. So that is our labor force participation and our Data Monday report for this week.
All right, thanks, Brian. Looks like your screen was still sharing there. I do want to let everybody know that we are going to be taking this Thursday off. We have our big SBAM Small Business Summit and annual meeting. And so if you would like to see us, maybe come visit us live and in person here in Lansing Thursday. It's a full day, 8 to 2 p.m. And you can learn more at sbam.org/events. Hopefully you have a great week, and we will be back here next Monday at 3 p.m.
Thanks, everybody. See you next week.